Hello, I'm Rich Owens, and I'm going to run you through this short video on FRM Part 1, Topic 1, Foundations of Risk. And we're in Chapter 3, the Governance of Risk Management. Now, you can think of this as kind of an overlay on top of Chapters 1 and 2. In Chapter 1, we saw the 10 building blocks of risk management. Chapter 2, how firms should manage financial risk. So Chapter 3, on top of that, we're putting in place the policies, the procedures that a firm should have to make sure they use those building blocks to effectively manage risk. Now, the LOSs we're looking at, the learning outcomes we're looking at. First of all, we'll look at the post-crisis response of the regulators. By crisis, we mean the global financial crisis of 2008. And really what we're looking for here is the change in their approach to corporate governance and risk management. We'll look at best practices in risk management governance, the role of the board and specifically the audit committee, and good news, we'll talk a little bit about risk appetite. Good news, because we've already met that in Chapter 2. So we'll talk about it again in Chapter 2. We said, what is it? What does the statement look like? Here, again, it's governance. So how do we make sure it's used effectively? But before we get into all that, let's just get a timeline of a selected number of regulatory responses to various crises over time, just so we know where the crisis, the GFC at least, fits into this timeline. Let's go back to 1988. That's when the Basel Accords started. The original with just credit risk, updated in 96 for market risk. 2002, we had Sarbanes-Oxley in the US, SOX. That was in response to Enron, WorldCom, really accounting scandals. We had Basel II in 2004, which brought in operational risk as well as credit and market. Then 2008, despite all of that, the global financial crisis hit. Now, we're not looking at this because we suddenly need to learn the ins and outs of Basel and SOX in this chapter. We absolutely don't. You'll get all over Basel in Part 2. But just to see where we were at when the GFC hit, we already had a raft of regulations in place. Post-crisis, which is what we're interested in this chapter, we had more Basel Accords, 2.5, a direct response to the crisis. The Dodd-Frank Act, dealing with banking in the US in 2010, on to Basel III and IV. So that's your backdrop. That's where the crisis happened. Now, what we need to do is talk about the response to that crisis in terms of the governance of risk management. Prior to the crisis, risk management was marginalized. People were focusing on growth and higher returns at the boardroom level rather than managing risk and risk-adjusted returns. The GFC exposed the inadequacy of corporate governance practices and, specifically, governance of risk management. What was happening? Well, there'd been a decline in underwriting standards, specifically looking here at banks, obviously. A breakdown in oversight. Leverage at some of the big investment banks was out of control. It was unchecked. And if you've looked at the GFC at all, you'll be aware of this, ever more complex securitizations were in place that people sadly just didn't understand. Going from your mortgage-backed securities to collateralized debt obligations to CDO squared, that even credit rating agencies couldn't rate correctly. Now, as we've said, this is despite regulatory action that had already been taken to address previous corporate failures, previous accounting scandals, WorldCom, etc. So what was the response? We've seen there was a raft of regulatory responses, but in addition to those listed, there was also in 2010 and then updated in 2015, a direct response to the lack of corporate governance from the Basel Committee on Banking Supervision, the BCBS. This report, quite detailed, quite lengthy, came up with a set of roles for the board, for its risk committee, senior management, and the chief risk officer, and detailed the role of internal auditors, which we'll look at in a little while. But to summarize, this is what it looked like. Now, obviously, that's a huge amount of detail. If you're on a smaller device, probably completely illegible. All the detail you need is in your BT study notes, so have a look through that at some stage. But what we're going to do here is just summarize the key themes that it came up with under two headings: the board and senior management, and risk. First of all, you've got to look at the qualifications and composition of the board and senior management. That means looking at whether they should be industry insiders, whether they should be outsiders, exec, non-exec. There were banks that failed during the GFC that had insiders on their board and those that didn't. It suggested taking a look at the governance structure, not only within the firm, but within a group of firms. So from the holding company downwards. And it looked at how senior management should run the firm. One thing it suggested, and I paraphrased a little here, but it said senior management should manage activities in a manner consistent with the firm's risk appetite. There's that phrase again. We'll talk about it a little later on. And it addressed the issue of supervision. One issue we mentioned earlier on, a lack of oversight prior to the GFC. So we're suggesting here one of the key roles for the board is that of supervision of the business of the risk management process. It also addressed the issue of compensation, the role that incentives played in the failure of risk management in these big firms that eventually failed. The fact that some compensation structures incentivize managers to take risks that did not benefit the firm or its shareholders. Under the risk heading, it specified that there should be a defined risk management function within the firm. There should be extensive and transparent risk communication throughout the firm so everybody knows what the risk objectives are. There should be very clear identification, monitoring, and controlling of the risks a firm is exposed to, and that internal audit play a huge role in ensuring all of this is present and running effectively. As we mentioned in the learning outcomes up front, we're going to talk about internal audit specifically a little bit later. So they were the major principles identified by the BCBS. Let's move on and talk about how we turn those principles into best practices in risk management governance. Well, it all starts with the board. The board has a duty to shareholders. The board is the agent of those shareholders, but must also be sensitive to debt holders. There are often conflicts of interest that will occur between the shareholders and the debt holders and other stakeholders. For example, depending on the compensation structure, we mentioned this earlier, board members, senior management may be driven by the desire for short-term profits, whereas shareholders are looking for long-term shareholder value. That is a conflict of interest. And good corporate governance is all about managing those conflicts of interest. The better the corporate governance, the better the corporate governance procedures that a firm has in place, the better those conflicts of interest can be managed. And corporate governance is difficult to separate from risk management. Good risk management requires good governance. It's so important that many corporations, in line with suggestions by the BCBS, have put in place a chief risk officer. Good corporate governance says that that chief risk officer should be able to operate independently and report directly to the board. GARP's underlying text actually has a good example of a CRO being ineffective through no fault of their own when the brokerage firm MF Global collapsed. Back in 2011, it had massive exposure to European sovereign debt. The CRO warned repeatedly that the firm was exposed to way too much risk as a result, but warnings were unheeded and the firm collapsed. So not only is it important to introduce these principles that the BCBS discussed, but also make sure they are effectively implemented by the board. So let's look at the role of the board in risk management. Here's a very clear definition of what their role should be. The board must ensure a clear understanding of the firm's business strategy and the strategy's implied fundamental risks and rewards. And to achieve that, we can look at 4 responsibilities. First of all, a word we've already looked at, oversight. The board needs to hold the executive team accountable. That means there needs to be a certain level of independence within that board. The CRO, for example, must feel comfortable reporting to the board when risk levels are unacceptable, must feel comfortable asking the board difficult questions. Transparency. The board should ensure there is adequate internal and external disclosure. Internally, everybody within the firm understands the strategy and the risks and rewards associated with it, and their risk exposure is adequately disclosed to their stakeholders. The strategy the board has put in place should expose the firm to acceptable types and degrees of risk.